right, why don't we go ahead and get going? Got a couple more people coming in, but appreciate everyone joining us on this Thursday at the beginning of December. I have with me as our guest Andrew Dunst from the Sage Group, and we're very excited to have him join us as part of our webinar series that we've done on a variety of topics here at Retina. But most importantly, or in particular with today, focusing on a lot of the core metrics that brands and direct-to-consumer companies should be focusing on for whether or not they're raising capital, looking to potentially sell, but most importantly, just run their business as well as they can. And so with that, I'd love to jump right in. Andrew, I'd love to introduce yourself real quick, share a little bit about you, as I'll share a little bit on myself as well. And then we're going to go through a quick number of questions for the audience that were introduced ahead of time, talk through a number of issues, and then open it up for the audience for more Q&A at the beginning. So Andrew, just turning it over to you. Welcome and thanks for joining us.
Yeah, thank you, Chris. And welcome everyone who is attending today. Appreciate it. My name's Andrew Dunst. I'm a managing director and partner at the Sage Group. For those of you that don't know, the Sage Group is an M&A advisory firm that focuses exclusively on branded consumer companies across lifestyle goods and accessories, beauty and personal care, and probably most relevant for this discussion, e-commerce and DTC brands, which I head up for the Sage Group. We are excited that we've worked with some of the leading direct-to-consumer brands in the country, including helping companies such as Bombas Socks, MeUndies, Chubbies, and many others raise capital and do M&A events. We help companies both entertain investments from private equity funds, growth equity funds, venture capital funds, as well as explore strategic sales to larger public companies and larger buyers that are within the space of our respective clients. I'm hoping today to share some of my learnings and thoughts from being in the market with many of these direct-to-consumer brands.
Awesome. Now, excited to have you here. For those of you who are not familiar with Retina, Retina is a data and analytics platform where we help our customers through our predictive AI and data science tools identify their best customers using predictive customer lifetime value to help identify, engage, connect, and retain those customers. And one of the things we find with a lot of our clients is that this question of who are their most valuable customers, who are their most profitable, really translates into a lot of the questions I think that get raised by some of your clients as well, Andrew, and as well as some of the investors. And sort of along those lines, would love to maybe just start, share a little bit about where the market is as we head into wrapping up 2021, which has seen a huge change in direct consumer and going to 2022. What's the market like right now for the e-commerce and D2C brands?
Yeah, no, for sure. Well, to state the obvious, the demand for e-commerce and direct-to-consumer brands is the strongest it's ever been. Certainly pre-COVID, the demand in the market was very strong, but since COVID, with the strong performance of e-commerce and direct-to-consumer brands, there's just been tremendous increase in demand from both financial investors, and when I say financial investors, those are private equity funds and venture capital funds and so on, but also from the larger strategic buyers. So those again are companies that are operating within the space or kind of operating businesses. Financial buyers are very excited, particularly post-COVID, about these companies because of the financial performance, the strong top line growth, coupled with meaningful profitability, which has accelerated for many companies due to some more favorable dynamics in the ad market and demand from customers. And strategics are even in more need for e-commerce capabilities and companies that have a fresh take on their industry. With the changing customer behavior, obviously much less shopping in stores, strategics need to leapfrog capabilities if it's in marketing, if it's in branding, if it's in customer analytics, and data science, whatever it may be. At Sage now, we think we've sold 6 e-commerce businesses to strategics. And in all those cases, we saw the same kind of theme, which was these strategics were antiquated and needed to leapfrog capabilities, and M&A was a key way for them to do that.
It's super interesting. And when you're having those conversations with the brands, particularly maybe some of the legacy players, what has changed from, say, a couple of, like even pre-COVID, but even say maybe 2 years before COVID? Is it purely just about the fact that they need to go ahead and build in a better direct consumer e-commerce experience that they didn't have before, or is it just a recognition they can't do it on their own? Like, how much has that changed?
Yeah, I think in a lot of ways the same priorities remain the same as they did pre-COVID, but there's just been such an acceleration of e-commerce penetration over the last 18 months. The way we think about it is fundamentally the same trends have just accelerated maybe 5 years in the future from where people thought we were ultimately going. So strategics are just becoming even more desperate to acquire businesses and gain these capabilities more quickly than perhaps they even thought previously. So I think fundamentally the same trends still remain. There's just been a dramatic acceleration of those. I will say though that e-commerce kind of standalone is probably even more exciting to strategics as wholesale and retail have become more challenging. I think pre-COVID, an omnichannel business that maybe had some wholesale and some retail and some e-com was maybe even in some ways more exciting to strategic because they could add a value in those kind of distribution channels that have already existed. Right. But now strategics are like, look, we don't care as much, to see brands prove out the success of omnichannel. We can worry about that later. What we want now is just someone who is pure play, solely focused on e-com.
Interesting.
That's where the world is.
Interesting. And so when they're looking at those direct consumer brands specifically, and this will go into one of the questions that we have. A couple of questions that were asked by the audience ahead of time, and we picked 2 of those questions just to sort of answer. And I forget the order we're in, but on one of them, the question of like, what are the key metrics between, particularly for a brand, as they think through both either profitability or growth, what does matter to these acquirers, and has that changed since they're focused exclusively on maybe more of a direct consumer than omnichannel experience? And then sort of we can talk and go into sort of some of the specific nuances of what those KPIs are, what those metrics are, and then ultimately what's the difference between those that are important for growth versus profitability.
Yeah. So, obviously it's a multifaceted answer, and I'll try to keep it concise in terms of the key metrics. But if I were to just, the first one I would say is ultimately looking at the customer relationship that whatever brand has. And when I say customer relationship, it's the retention, it's the growth in lifetime revenue and lifetime value over time, and truly ascertaining, is there a sticky, loyal customer that this business or whatever business attracts.
How do they measure that?
Yeah.
What is a sticky product? And how does that change over time?
Yeah. So I think in terms of customer relationships, there's 2 parts, right? There's the first order. So, how much money do you get from a customer immediately? And then there's the question of, well, how many times do they come back, and how much more money do they spend over a lifetime? And we typically measure the life of a customer for everyone as a rule of thumb within 3 years, with the rule of thumb being that after 3 years, it's kind of anyone's guess what happens. But within that shorter window, there's brand loyalty.
Mm-hmm.
And so that's really what we look at, is to say, okay, how much money do you get from a customer upfront? And then how much additional or incremental dollars do you get from a customer over that remaining 3-year period? And that's super important to understand that growth from that first order. So If you get, let's say, $100 out of a customer in the first order, do you get $100 of additional dollars, or 200 additional dollars, or 300 of additional dollars. And we can then start to also benchmark across different companies. Obviously at Sage, we have a lot of data, but many buyers have potentially hundreds of companies that they've looked at. They can start to say, okay, is this retention strong or not? That's really where I've seen probably the number one point of focus be for e-commerce companies.
Got it. And so want to follow up on a couple of things, and there've been a couple of questions that have come in from the audience where I want to unpack a little bit. And I actually had sort of some similar questions. So you mentioned sort of like your preferences for sort of a 3-year LTV calculation, which is interesting because one of the things is like here when we work with our clients, we look at projected value from like a 1, a 3, a 5, even maybe up to a 10-year. We'd argue we're able to do that in part because our models and solutions are better, so we can provide the accuracy necessary to do that. But also, I think sort of from a realistic perspective, from the perspective of what is the length of the companies, like why 3 versus 5? Like, is it just because of the accuracy? I mean, presumably if a company is buying someone, they're expecting this to be, they're expecting to hold this company and those customers for more than just 3 years, but ultimately for a much longer period of time.
Yeah. And look, as is life, nothing is set in stone, and there's gray areas to everything. And kind of 3 was the number I threw out, but of course you can look at 5, you can look at 4. We have looked at greater than even 5 years. I think part of it also depends on the product category. So categories like that are much more discretionary, like jewelry or footwear or businesses like that. I think people want to see that there's a lot of growth in lifetime revenue in a short period of time, because customers ultimately change brand preferences or maybe grow out of a brand that they like and mature and go to another brand. But for more commoditized categories, if you're selling personal care products or what have you, then I think a longer term horizon makes a ton of sense, right? Because those are consumable items that come part of your daily routine and you buy over and over and over again.
Right. And on this question of metrics and sort of the calculation, sitting there right in the middle, what is sort of one of the biggest, this is sort of addressing a couple of questions that have come in terms of sort of defining what LTV is. How do you typically see your clients define LTV versus, say, a prospective buyer or investor? Like, what are the differences that occur that you sometimes see as a disconnect, and how do you help bridge that?
Certainly. So actually, and it's a question we get asked all the time. I want to note that there's a difference between lifetime revenue of a customer and lifetime value of a customer. In the investment community and strategics, those are different. Lifetime revenue is the net sales you get out of a customer within whatever defined period of time you're looking at. It could be 3 years, it could be 5 years, 7 years, whatever period you want to look at. So that's what we would call fundamentally lifetime revenue. Lifetime value we define as essentially the net profit you get out of that customer within whatever defined period you're looking at. And by profit, I'm referring to essentially the net variable margin on that lifetime revenue. So essentially we look at all of the product costs associated with the actual products itself, so a product margin, and also take into account all of the fulfillment costs associated with getting the products to the customer, as well as any selling costs, which would include primarily merchant fees and if there are any finance fees or things like that. And then we like to marry up and compare that lifetime value, which is essentially a net profit, to the customer acquisition cost, i.e. the cost it took for you to get that customer in the door day one. And you see essentially what is that cash on cash return. So when you put in $1 of marketing, how many dollars of profit do you get within X defined period of time? And again, you can look at it many different ways. But that is fundamentally, from our perspective, the hallmark and the key barometer of a successful e-commerce model, as it, of course, relates to your marketing spend. That is a key metric that is evaluated.
And when rapidly growing call it a startup or early stage companies, when you've worked with them or spoken with them, are they clear on sort of what lifetime value is, and or do you have to help them sometimes calculate it or change what the perceived answer is going, or what the perceived answer or point of view is going to be for a potential investor?
Yeah, no, it's a great question. So I'd say earlier stage companies, well, and actually I think one of the participants actually asked this question, which is, when you're a really young business, how do you know what your lifetime revenue or lifetime value is? And, honestly, they don't. It's a very hard thing to answer. And it does take time for you to learn what the lifetime revenue or lifetime value is of your customer. And that is why, later stage, much larger private equity funds and larger strategics typically like to look at businesses that have a little bit more operating history, so they can see multiple years and start to really ascertain the repeat rates of customers. However, even when you're an earlier stage business, you can start to get a very good sense of retention, even after a year or even after 18 months, because we fundamentally found at Sage, looking at all the clients and even speaking, the hundreds of conversations we have with investors, that, much of the repeat that happens really happens within that first year or 18 months. There's of course a much smaller subset of hyper loyal customers that will be with you for many years. But we find that after your 18 months, you can get a very good sense of this stickiness, as we call it, of the customer. And then from there, you can kind of extrapolate out. And, we're working with some younger businesses right now that were, founded in 2019 and are growing rapidly. And we've had to estimate the lifetime value to a degree. Now, if, with your services, Chris, at Retina, I think you can get much more granular and precise on those predictions. We did it a bit more, broad strokes just based on trends, but I think that's a key service that you can offer, that you certainly can help with, particularly for earlier stage companies.
Yep, we definitely try, and I think one of the things that we find with lifetime value, as you pointed out, is its applicability across so many elements of the business. Which are the right customers to acquire? How do you engage with them? Who are the right customers to continue to bring them back for that additional purchase to increase their value, which is incredibly important. Yeah. And on that note, I think actually on sort of this topic, I want to follow up on the question that's posed on the screen right now, which is the poll. For our audience, what are people most focused on right now, or what do you believe is sort of most important in sort of profitability versus growth? So you get those answers in real quick. Interesting.
Yeah.
All right. So it is fairly close based off of sort of the initial poll. I want to say, changing head. We'll give it another minute while we let people answer. And I want to go ahead to another question that was raised in the audience as people vote. And this actually goes to, I think, a couple of comments that you made about why particularly strategic brands are interested in acquiring a direct consumer, particularly post-COVID. And is there something besides just revenue that they're looking for? Is it domain expertise? You sort of mentioned that they care less about maybe the omni-channel. Hey, I can sell this in a store. What else do they care about from a tech stack, from a brand? People who actually understand fulfillment. What are they looking for?
Sure. Yeah, it's a great question. I would first start out by saying fundamentally what will get a strategic excited is the brand value they see in the company. So regardless of what capabilities or infrastructure it might be built, fundamentally to get a premium valuation, the strategics don't want to see that they believe there's a highly differentiated special brand that has a very strong emotional connection with customers. And they're doing that because many of the strategics, legacy brands have lost their shine, have lost that connection with customers. And so these strategics are trying to find assets that have that connection that they, maybe had decades ago. But beyond that, of course, I've found that where strategics have the most efficiencies is on the kind of marketing customer analytics side. So understanding, and when I say marketing, I'm also referring to content So understanding, hey, how do you actually figure out the best ads to deploy, right? How do you figure out what content works? The copy, the photography, all of that. Some of these strategics, even when they can hire people from other companies, they just fundamentally have a lack of understanding on how to do that. And then they also have a lack of understanding on, the KPIs, the analytics, the customer KPIs like lifetime value and repeat rates, and slicing and dicing it 100 different ways. Some of our clients have had full team of data analytics and data science people on staff that all day long are just crunching cohort data and crunching metrics for the management team to make decisions. And strategics are excited about those capabilities because they say, wow, if we could gain those and apply them to our core business, imagine how much additional revenue we can ultimately unlock in our business.
Right.
And then the third I would just say is, I do find that by and large, strategics like e-commerce assets that are profitable. Of course, there's exceptions to every rule I've mentioned, but strategics are largely the public companies that report earnings per share, which is essentially is their net income, and they ask, well, by acquiring this company, will it be dilutive to my earnings per share, meaning reduce it, or will it increase it? And by and large, strategics like to acquire businesses that increase their earnings per share, meaning increases their profits, because that's ultimately how they're valued fundamentally, is on an earnings per share. Now, of course, publicly traded e-commerce companies are an exception. They're more so getting rewarded just for top line growth, and profitability comes later. But for these legacy incumbent businesses, right, these behemoths that are old school, for lack of a better word, they really care about profitability.
Yep. And sort of on that note, we're going to close out the poll. And what is interesting is, I think most of our participants have growth metrics, as being more important than profitability metrics. Although there are a couple of questions or clarifications which are fair observations, which is kind of depends on what the life stage of the company is. And perhaps like that, it depends based off of that. So what are your thoughts on the poll and the response and the feedback from the audience?
Yeah. Well, look, firstly, it's a question actually I get asked by any company we're talking to. Earlier stage, later stage, everyone wants to know kind of the same question, or wants to know the same answer, which is, what's more important, profitability versus growth? And I think one of the participants made a very good point, which is the answer is it kind of depends, and it's kind of both. And I know that's probably those least helpful answers, but if I were to elaborate, firstly, I do agree that in earlier stage business, that's maybe 1 year old or 2 years old, fundamentally may not be generating, bottom line profitability yet, because they're investing in infrastructure ahead of growth. They're building out team. They aren't getting necessarily the leverage on their fixed costs yet. However, at an earlier stage or a later stage, what we fundamentally care about is what we call the unit economics of the business, which essentially means looking at, customer spend from an AOV perspective. So, what's the AOV of a customer, and then what's that cost per acquisition? And first and foremost, are you first order profitable? Meaning, after you invest in customer acquisition costs to get that customer in the door, have you immediately made money? And if the answer is yes, then you're first order profitable, right? So you have a self-generative, cash generating marketing model. And at all stages of a company's life cycle, investors look for that. So at an earlier stage or later stage, people want to know, are you first order profitable? And then from there, the question is, well, how much additional revenue do you get out of a customer? And that is, of course, harder to judge at an earlier stage. But I think, Chris, overall, people will always be looking for first order profitability.
And sort of like, yeah, I was just sort of thinking, sort of taking a recent example in the public markets, I think about, and just connecting with a couple of the other points that you raised about repeat purchase. I think about Casper right now as a company that, the frequency of purchase is low. and they were never really highly profitable. And that clearly impacted their ability and the valuation of the company and ultimately their performance. Do you see them as a poster child, like, for lack of, not to unfairly pick on them, maybe, or maybe fairly, as a poster child for not properly addressing some of these core, metric issues about how to run an e-commerce business?
Sure. Yeah, and I agree. We don't want to pick on Casper. They've built a great brand and built a lot of value. I think Casper ran into two issues, and I think one was they're probably just a victim of kind of the earlier stage mentality of venture capital, which is growth at all costs. But fundamentally, what investors saw once they dug under the hood was Casper doesn't have, as you said, a lot of frequency of purchase, right? You buy a mattress, I think on average every 7 years or 8 years is the average. And so what Casper needs is what I was actually just talking about, which is first order profitability. You're going to make almost all of your money out of the customer's life on that first order, right? And so when you do that, that's obviously they have a very high price point, so they can, they have a lot of room in terms of ability to spend on marketing. But Casper was pushing marketing so hard that they were squeezing out the amount of profit on first order. So when you're not making a lot of money on first order, and then you also don't have that frequency of purchase, that's a business model that investors sees as not sustainable. Casper, though, also ran into an issue, which is, I think probably less about e-com metrics and just more about their industry, which was the mattress industry became unbelievably saturated. And so marketing costs started to get extremely expensive. And it is important in any industry to ask yourself, what are your barriers to entry? What's your moat around your business? Besides Casper's kind of, I guess, first mover advantage and brand cachet and awareness, their product, I think people would perceive as largely undifferentiated versus others. The foam mattress industry is quite, I think, commoditized now, and there are a lot of low-cost solutions where people would argue is similar product, especially on Amazon. So I think that was one of the issues they ran into as well, Chris. But yeah, fundamentally, that first order profitability was probably the most.
So there's so many things I want to follow up on with that, and one of them specifically actually relates to a question we have from the audience from Frank, which is, how do investors look at defensibility? What are metrics? And IP claims seem dead, and platforms have commoditized a lot of solutions, which I think you've alluded to. But to his question, like, what do investors view is defensible?
Yeah. So firstly is really asking themselves, do you have a strong brand and product? And I know that's in some ways a subjective, set of metrics, but investors like to say, okay, at the end of the day, what you really have is your brand. And how does your brand differentiate itself in the market? Is there a clear white space that you're going after? Again, as I mentioned, Casper, I think people saw that it became quite commoditized, and there were a lot of companies kind of doing the same thing. So ultimately, someone says, do you have a truly differentiated brand? And by the way, the strength of the brand is measured in different ways. It's obviously measured in things such as, how well do customers respond to your business over time? What's that stickiness that I talked about? But there are also kind of more quantitative ways. I shouldn't say quantitative, but softer ways actually that you can look at it, such as social media presence. Are you building community? What's your things like Instagram followers and Facebook followers, TikTok? What's the engagement on that, on those platforms as well? What organic buzz is there around the business? People look at PR, still, like, are you generating, articles in magazines, and, are people talking about you? Those are other ways that investors start to say, okay, is there a differentiated brand and product here? Fundamentally, that's what we see as the moat around really any of these businesses we sell. If you look at Bombas or MeUndies or Chubbies or, Pura Vida, Blenders, any of these companies we sold, investors believed, and we believe that, there are very differentiated brands in those categories.
And sort of following up on that, I mean, what the, and when investors initially invest in one of these brands and what they're thinking about, to your point, whether it's Casper or Pure Vita or MeUndies or Bonobos or Bombas, the market and the market changes, and how businesses are expected to perform changes. And so what do you think are some of the things that have most importantly changed in terms of expectations from an investor, say from metrics that they were maybe potentially looking at now versus 5 years ago?
Yeah. Well, 5 years ago or even 7 years ago, if I go back a little bit farther, those were kind of the earlier days, at least, of these DTC brands. Obviously e-commerce has, been around since the late 90s and so on. But in terms of these DTC brands, I think there was a first wave of businesses that were launched and got so much excitement just merely by the fact that they were direct to consumer, just merely by the fact they had an e-commerce website, because the capabilities were really still just kind of in its early days of being developed. Shopify was not nearly as prevalent 5 or 7 years ago, especially, Shopify Plus was still not really being used by a lot of companies. I still knew so many businesses on like Magento and these platforms that cost millions of dollars to develop and service. So you needed teams of developers and so on. And then, this little thing called Shopify came along and kind of revolutionized this whole market, because it made it very simple for really anybody to start a website. And so what happened was, I kind of saw there was a second wave of businesses that were started where it was, maybe a single entrepreneur or two entrepreneurs start a business together, and they just launch a website with very little, if any, capital. They go and source stuff from China. They go source stuff directly, from manufacturers, and out of thin air, they create a brand. And again, back in the day, you did need capital to do that, and venture capital firms were just so excited by the fact that you were just merely DTC. Now, again, with barriers to entry being much lower, what's shifted is from just, again, revenue growth and just by mere fact of being DTC to saying, okay, what category do you play in the market? What's your differentiation within that market? Which market share are you taking from? And, fundamentally, do you have a sustainable operating model? I think 5-7 years ago, people kicked the can down the road on sustainability and profitability just for the mere fact of being excited about growing the top line of these businesses and capturing market share. But now people want to really see a clear line of sight earlier.
Right. And I want to sort of go back, take that in terms of things that have changed, and sort of going back, you sort of mentioned how marketing has changed, and circling back to one of the original comments you made regarding like one of the things that a strategic brings to the table is like typically like a much bigger marketing expertise, understanding across much sort of channels. How has marketing spend and sort of channels changed over time, for some of these brands, and how they think about it, versus 5 years ago when you maybe measure just in CPMs versus now? Like how is that marketing?
When I bring up kind of the sustainable operating model being very important now, it's really stemmed from the fact that 5-7 years ago, social media was still forming. I mean, it was mature in some ways, but Instagram, for example, right, and Snapchat were still much earlier. And so investors were very excited about backing businesses that could take advantage of what they perceived at the time to be very cheap forms of customer acquisition to go direct to the customer, right? I remember some clients were telling me they remember when CPMs were like less than $1 on Facebook and on Instagram, or advertising on YouTube, they were getting CPMs for 10 cents, and so you just couldn't pour enough money into these marketing channels, right? But what happened is with the saturation of competitors, obviously that drove up the cost of CPMs dramatically. And just because CPMs go up doesn't mean that it becomes harder to market. But what it then means is that, that long-term relationship with the customer and the amount of total profit you have to get for that return to make sense just increases dramatically. And so what investors start to say is, now, okay, with expensive CPMs come a high CPA, right? High cost per acquisition. So show me that there's a strong multi-year relationship with the customer to justify this spend. And if you can do that, then investors love the model and they say, look, we still don't, we can't pour enough money into this, into marketing. But again, back in the day, people just said, look, customer acquisition costs are so cheap. Let's just pour as much money we can into marketing. Let's raise as much money as we can. And then what happened was, again, the marketing environment got very tough. And that's why there's headlines, about people like Casper and others that, really struggled to ever get to profitability because they were just spending relentlessly on marketing, and kind of the CPAs hit them very hard.
And with those changes, and sort of another question sort of related to from the audience, when you're advising your clients or sort of talking these conversations, do you help sort of provide them with a framework about how to think about those KPIs, particularly if maybe they're thinking from a point of view that's maybe out of date or not current with what the market expectations are?
Yeah. So sorry, Chris, actually on my end, you'll cut out for a minute. Could you just repeat the last part?
Yeah, I was just asking, do you, as you're preparing your customers or a potential client to think about, do you provide them with a framework to think about these KPIs and help them sort of guide them through that process and sort of like potential actions that they can take to improve those KPIs for the purposes of a capital raise or sale?
Sure. Yeah. So what we first tell our clients, and this goes really to the poll, which is, what do you focus on, profitability versus growth? What we tell every one of our clients is to ultimately figure out, have some estimation on what they believe is the lifetime value of your customer, right? And say if that's within 2 years or 3 years or 4 years, what have you. And we've sometimes helped companies develop, understanding of LTV and so on. And then say, okay, we know that investors like to target a certain ratio of LTV to the customer acquisition cost. Meaning, again, if you spend, if you have $100 of LTV, investors sometimes, that like a rule of thumb is that you get $3 of profit for every dollar of marketing. So meaning a 3-to-1 ratio. So, if you have $100 of LTV, then again, dividing by 3, that means you spend $33 on a CPA to get $100 of profit out of a customer, right?
Yeah, so a quick question on that. Yeah. The 3-to-1 ratio of LTV to CAC is something that sort of considered, I guess, a golden ratio or traditional thinking.
Yeah.
Is that still the number that people should be thinking about now in this environment? And how is that vary over, is there some nuance there, across different industries? Say, something that is a subscription service, like where you have a monthly recurring charge versus an infrequent purchase like jewelry, like you mentioned.
Yeah. Yeah. So I think after a 3-year period, let's say, or 4-year period or 5-year period, that 3x, I think can be actually compared across any company, right? And that's actually why people like the metric, because you can compare it across industries. It's ultimately saying how much profit do you get for every dollar of marketing. I think that's something that anyone wants to see after a certain number of years. And that 3 metric just depends. I mean, if you go lower than 3, then you're pushing more for growth. And if you go higher than 3, then you're optimizing to profitability, generally. Again, and there's exceptions to all this, but generally speaking. But Chris, I think the important thing is, if you're more of a subscription model, that upfront ratio, meaning that first order ratio, doesn't have to be, profitable. You can maybe be negative on first order. And that's why some subscription businesses are actually very negative on first order, right? They might spend $40 to acquire a customer, only get $10 of profit, right, initially, but they know they're going to get so much over time from predictive, subscription behavior. But for, again, a more discretionary purchase, like let's say Casper, again, just using them as an example, that repeat is going to be nil. So you need a lot of profit on first order to ultimately get that ratio you're looking for.
And then taking that ratio, that 3 to 1, or sort of any LTV to CAC, and you brought up a great point, which I want to talk, like, what is there a time frame, that certain investors think about in order to achieve that call it that 3 to 1 ratio? Is it that sort of 3-year expectation is sort of a general rule of thumb, or a good reference point to say, look, at least if I can achieve that in 3 years, it makes sense, relative to maybe, and then at that point, maybe I've introduced a new product or something along those lines. But timing, I would think, matters. So, like, how does that factor into these calculations and metrics?
Yeah, I think, again, 3 years is a good barometer. If you actually look at public companies that have IPO'd, like big e-commerce businesses, and I mean, if it's like Revolve back in the day, or any the Warby Parker, and any of these that are publishing now, they're using anywhere between, I see, kind of a 3 to 5 year horizon. So when they talk about lifetime revenue and they talk about this lifetime value to customer acquisition cost ratio, there's typically they're looking anywhere between 3 to 5 years. So that's pretty generally the time frame to be looking at.
Got it. And that's great. Moving on to sort of another question that came in from the audience ahead of time, I want to talk about sort of this question of, and we've talked about customers and data and everything, but how should brands, particularly direct-to-consumer brands that presumably are collecting maybe more information about their customer, how should they leverage that data to make better decisions? And ultimately, how do those better decisions show up in sort of some of the metrics? Is it an assumption that you take that information to be able to optimize your advertising spend more effectively, to engage and retain customers better? What are some examples of where you've seen some of your clients use their data in really effective manners?
Yeah. So, and this will be important for anyone who's on this call that wants to entertain any form of investment from a financial group or a strategic buyer at some point in the future, which is having a very strong grasp on who is your core customer. So someone asked a simple question, what does your core customer look like? Being able to answer that easily and with data is going to be extremely important. And there are lots of ways you can look at that. There's obviously simple methodologies, which is like going on Google Analytics, right? And going on the Facebook Ads Manager. But those offer somewhat limited views into who your customer is. It's largely age and demographic and geography and maybe some interest-based data. But I found that the clients I've worked with that have the best understanding of their customers are ones that are leveraging other forms of insights. That can be forms of surveys. I highly suggest to anybody to not be afraid to just ask your customers about themselves. Customers are surprisingly very open, considering everyone's concerns about privacy and things. I find my clients can ask customer surveys like, hey, how much do you make? What's your background, X, Y, or Z? And they'll get 10,000 respondents within a day. And those are extremely valuable insights that aren't always available within these traditional ads, and start to figure out who is that most loyal customer. We have a saying that, the 80-20 rule, which is not our saying, but it's saying, which is, 80% of something is driven by 20% of something else. So in the case of your customer, marry up these marketing insights.
I don't know, not sure what that was.
But the more you can marry up those insights with your marketing, the more effective your marketing will ultimately be, right? So having a strong grasp on your customer will just allow you to ultimately market better to attract that core customer.
And with those, and then how do you talk with your customers about how they you take that, call it third-party data, and layer it in with, say, like how they're actually purchasing behavior. Because to your point, and part of it's create a holistic point of view of saying like, look, this is the background, this is what people say they are, but then actually connecting the dots between who they say they are and how they're actually, buying frequency of purchase. Are customers able to do that? Are your clients able to effectively do that or not?
Yeah, I think our clients are generally able to, I think do that. I mean, overall.
Yep. No, totally. It makes sense. As we're sort of coming up on the top of the hour, there was one or two other questions that were out in the audience, but also wanted to. This was a question that came up earlier, and curious what the audience thinks about, which is, and particularly relevant for direct consumer brands, is your brand currently utilizing Amazon? So I want to see, what the audience thinks about use of Amazon for selling their product. And then while we're talking about that, maybe sort of a preface for that question. Another question that came up from, hopefully pronounce this correctly, Maddie, is creating an app that's in beta, looking to raise a pre-seed round. What are metrics to focus on since we don't have a daily DAU and retention data yet? And specifically, given that they're focused on a narrow group of beta users to refine the use of the product. So that maybe a little broader, open-ended, because it may not be direct to consumer, but generally, when you've talked with investors, what are some of the things that they've shared with you that have excited people early stage in a company?
Yeah. So at an early stage like that, what you really have to sell is the market opportunity. You have to sell the white space. You have to sell that, there's this gap in the market where there's this clear need from customers, and that this app or product is servicing that need. Some of the findings and things we've discussed and the metrics we've discussed will not yet be known, and that's okay. But early stage investors are really just focused on the large market opportunity. Later stage investors are much more focused on the diligence and the metrics. But that's what I would say, Chris, is you really got to just focus on the big picture and the big market opportunity. And also trying to size up what we call the total addressable market, i.e. the TAM is a term used a lot, which is what is that overall market you're going after and trying to attack.
And when you talk with, what do you see as sort of for someone in the audience, like what have you seen as best practices for actually calculating that TAM, particularly for a direct-to-consumer company?
Yeah, look, it's not easy to do, of course. So I think the first thing to start with is just basic research. Obviously, Google is your friend. You'd be surprised how much is just fundamentally out there on a variety of anything as it relates to market data. So I'd say that's the first way to do it. And then the second way is don't be afraid to just network a lot within whatever sector or industry you're trying to attack. Talking to industry executives, talking to consultants. I think just starting to immerse yourself in whatever market you're trying to attack will actually give you quite a lot of insights that will ultimately allow you to gain a better understanding. Of course, you can pay many thousands of dollars and try to buy research reports, but if that's not an option and probably not even necessary, I think those are the two ways I would go about it as like a very early stage company.
Awesome. Just going back to our poll as we sort of wrap up, it's about only a third, well, a little more than a third of our audience is actually currently utilizing Amazon. What are your thoughts on the role that Amazon plays right now in the ecosystem, and how does that change? And if you are a growing brand, how should you think about Amazon? And maybe the last part of that question is, what do other strategics think about if you have a meaningful percentage of your sales, via a channel like Amazon?
Yeah, there are two schools of thought on Amazon. Some investors believe that if you're a highly differentiated brand, there really is no place for Amazon, because Amazon seems to really be for commoditized products. It's hard to differentiate yourself on Amazon, right? You're just sitting on a shelf with many different companies. It's hard to convey the differentiation and the special, kind of brands and content that you've built. But there's also a school of thought that says that, e-commerce or your direct consumer website and Amazon are not mutually exclusive, which is they can actually work together very well. I fundamentally believe e-commerce, your own website, should be a vast majority of your revenue, 60, 70, 80%. But could Amazon be 20 or 30% and really be used more for a customer acquisition tool where you perhaps put a very limited assortment of products on Amazon, maybe just a couple of your best sellers, maybe in more of some of the basic colors or SKUs that drive a lot of revenue, and allow that to be a discovery point for customers that are addicted to Amazon. I think there's at least a saying I heard a year and a half ago. It's always stuck with me, which is, about half of all product searches, product discovery starts on Amazon. So the reality is, why would you not want to be where, half of the internet is essentially finding out about new brands, right?
Right.
And then the key is to figure out how to take that, those customers and ultimately get them back to the site. And so that's why kind of giving them just enough to discover, but not giving them the whole assortment, will allow them, or at least you think that there's a higher likelihood that they'll ultimately come to your own site to buy subsequent products.
And I think that's a great segue just to sort of, as we sort of wrap up, just sort of one last question, which is, do you consider Amazon as a form of omni-channel strategy? And, if not, what are some of the other omni-channel, what is an omni-channel strategy that stands out? I think you alluded to the fact that this is less important now, maybe for a strategic brand. But are there elements that are particularly important? And to that end, like, how do you define an omni-channel? What to you is an omni-channel? And it's a term that gets thrown around a lot, maybe not always with the same meaning.
Yeah. So yeah, for those on this call that may not know, omni-channel essentially means that you sell in multiple channels of distribution, meaning you sell in, let's say, e-commerce, you have your own stores, and then you also may have wholesale, meaning you're selling your products to other retailers, right, that are then selling your products. So omni-channel essentially means that you're in multiple channels of distribution, right? And in terms of how do people value and look at omni-channel, by and large, it's positive. We kind of stress to our clients, and we believe that what investors want to see is that omni-channel can play a supplementary role to growing e-commerce over time, but fundamentally the focus of the company and all of the focus time of management needs to always be on how to grow the e-commerce business. So if there are ways to be other places where your customers shop, meaning create a few stores in flagship cities, right? Or sell into a few key wholesale accounts where you might believe your core customer also shops, why would you not want to be there to allow your customers to discover your brand in a different way? And then again, like Amazon, figure out ways to get that customer to then ultimately come back and buy from your e-commerce site for years to come. That's how we think about omnichannel.
Awesome. No, and so many questions. I know we're sort of at the end of our time because of a lot of questions. Would love to talk about how brands think about the merging of the data across those channels from somebody within a store, going back to being online, how important that is to, to the success of a company and measuring their metrics as well as to investors. But since we are wrapping up, I just want to make sure and see if there are any other, questions from the audience that we could answer. And if not,
Chris?
Yeah.
Sorry, I did just want to mention one thing on Amazon. And I did see someone said, well, you don't own your customer data. And by the way, that's exactly right. I mean, that is the challenge with Amazon, is that you don't own that customer. You can sometimes see data, but you can't use it. Amazon does give you exposure sometimes to like email addresses and shipping addresses if you're fulfilling products instead of Amazon fulfilling products, but you really can't use that data. You're going to just get kicked off of Amazon. So That is why I say keep Amazon a small portion of revenue, right? But use it as a brand discovery platform. And then you can ultimately do attribution through surveys or whatever to figure out, okay, what percentage of my new customers on e-commerce came from Amazon, to start to figure out, is Amazon actually working? But fundamentally, that's why I believe Amazon should always be a small portion of revenue. And investors fundamentally value Amazon revenues less because you don't have that customer data.
Got it. Okay. No, I think that's a great point. And I think a great place to end with those last insights. So Andrew, no, thank you again for taking time. Really enjoyed our conversation. Like I said, I have so many more additional follow-ups I could do on this. But for anyone in the audience, please feel free to reach out to Andrew and myself.
Yeah.
And we look forward to having you at future. I'd love to do some future sessions on some other subjects.
Great. Thanks so much for having me, and thank you everyone for joining.
Thanks very much. Appreciate everyone making the time today.
Thanks everybody.